Welcome to International Securities Exchange's podcast series. Facilitated by renowned educators, ISE podcasts are intended to teach beginning as well as seasoned investors the ins and outs of trading. To find an updated list of podcasts, please visit www.ise.com/podcasts. Please be sure to listen to our important message following this episode regarding the risks of investing in exchange-traded options.
As a matter of fact, you might even say, we're getting to a point now, I'm just going to pull up a 3-month vol. The gold line here is actual implied volatility for 30 days, and the white line is historical volatility. But a lot of people will say that implied volatilities on almost any option contract can very rarely get below 10. So there's a very high complacency in the marketplace right now as far as what's going on in the currencies. And now why, I should probably give you some fodder as to why they can't think implied vols can go below 10 is because there has to be some time value in the option, right? And implied volatility is in a direct correlation with time premium. And if you had absolutely zero implied volatility, you would see an option trade for almost the intrinsic value. There'd be a time factor in there too, but that very rarely happens that somebody is going to sell you with a zero implied volatility in it. So we're at all-time lows. So if you were, I very rarely say, let's just go out in time and actually look at a long straddle. But in this instance, I don't think this is a bad situation in that even with the euro, or if you see any discrepancies in the marketplace, there's still a lot of concern about the U.S. dollar and the strength of it with all the debt that we put on. But if you look at the November calls and the November puts going through the volatile months, right? November, the end of September, all through October, going out to November, we can actually go out 67 days. And if we do the straddle, and I'm just going to kind of show you really quick, like I can highlight this. I put a B here and a B here, and I hit straddle and I hit get quote. What it will do is actually pull up the straddle for me in a nice little box over here. And it says I can buy this straddle for $2.74. The actual mid price of the straddle is $2.67. So looking at this, do you think that the market could move $2, $2.50 over the next 67 days on the discrepancy between the dollar and the euro? And if you do, this is actually a play that you can do. There is no major event that we're looking at here. I'm just thinking that vols are so low right now that I would be tempted to do straddles in a lot of the currencies because I still think there's going to be volatility going forward, and at some point in time I could see this thing trade for a premium, and if it does start moving, I would expect maybe volatilities to go up over the time frame. So very rarely do I just look at an opportunity where, gee, out longer in time, straddle might occur, might be a good trade to do. But I'll tell you, the marketplace is definitely discounting options relative to what happened last year and what's going on in the market. Even with the volatility index, which is really low, down around 23 now, we're at almost a 52-week low. We're very close to our 52-week low in the volatility index, too, to go along with it. All right, so I guess that's my play for the day as far as the currencies are concerned. And this is the actual euro versus the U.S. dollar. All right, I got a question that popped up. That's not too bad. It looks like a pretty good one. With low vol, would you do a 6-month or a 9-month straddle? Well, with low vol, if you're just doing low vol, you can go out as much as you want. It's all about your risk parameters. I'm just thinking the reason why I picked November in this instance is that I think that October is a scary month. And if I'm going to do something where it's a non-directional, in other words, I don't know where it's going to go, I just want it to go, I wouldn't mind being long a straddle throughout the October time period. But you start going out 6 to 9 months, now you're putting a lot of risk on the table. Even in this instance, like let's go on out and look at the March 10. The March 10 option contracts have 186 days. And if I look at that, I mean, now I'm starting to trade. Now I got $5 of risk on the table. 211 and 284. So let's say 3, 4, 5. Yeah, we're looking at about $5 here. So now, are you saying, are you willing to risk $3 on the straddle? Are you willing to risk 5? You get a lower rate of decay, but you definitely can go out further in time. But look at the vol. The vol is 10%, 11% on this option. 13 on the call. This is the at-the-money option. That's the vol that we usually quote. So very, very low volatility relative to what it was a year ago and relative just in general, even if you went back probably 2 years in time or 3. All right. So, but my moral to the story is when I talked about straddles, I didn't talk about straddles because I love straddles. I talk about straddles because I think it's important when you address any strategy to understand the Greek that's driving that strategy. And in the straddle, the gamma is what's driving it, not theta. People worry about theta, but they don't realize when I'm buying this long option and I'm buying 2 of them, yes, I have a high rate of decay, but I really need, by going out so far in time, I really am hurting my bottom line as far as gamma is concerned relative to theta. So, you know, and that's a very valid point too. So to address Addison's question, if I go way out in time and I go out 6 to 9 months on that straddle, I'm going to have a very, very low overall gamma. And so there's another reason why I probably wouldn't go out so far in time. All right. Now, but if I'm ever trading them around the vent, I want to get as close to expiration as possible. As a matter of fact, even if the option had 20 days to expiration and it was the only one that I could trade, I probably wouldn't even trade it. I just would wait for a different opportunity and do it at a different time. I wouldn't do the straddle overall. Vega. So let's pull up Vega. Vega is the amount of theoretical options price will change for a corresponding 1-point change in the implied volatility. Now, it's very important to note that Vega tracks implied volatility, not historical. We're not talking about what the stock has done in the past. We're talking about what is the implied volatility right now and what's going on. Oh, and I'm running out of time. Okay. The more time premium that's in the option, the higher Vega is for the option. By that rationale, longer-term options will have higher Vega than shorter-term options. And it's kind of amazing because I get a lot of people that do calendar spreads, and they always think of a calendar spread where I'm selling a near term and I'm buying a far term as a trade where you want implied volatility to go down. A lot of people will do this around an earnings event. And you have to be very careful for that because of bullet point number 2. Options have more time premium the higher the Vega is for each option. So as I go further out in time, Vega becomes a very large number. Now, by this definition, if I have a $4 option and Vega is 10, and IV was at 60, which is very possible in this marketplace, and it went to 59, we should actually see our option lose 10 cents. And Vega is a very powerful Greek, and if you look at it on a position basis, let's go on in here and look at Vega on our long straddle on a position basis. Alrighty. There it is. All right. This will show you this is a positive number right now. We're looking at 4 days to expiration. But we're talking about, let's go out further in time and we'll see it get much bigger. Remember, we moved this to 8 days to expiration. Let's put the stock back to 120. Hit calculate. All right. Hit plot. I'm sorry, I should have hit plot. 120, hit plot. And now let's hit calculate. We see our Vega at 10. That means on a position basis, if volatility goes up 1%, this position would make $10, right? Because we've got the Vega on each option at 5. Now let's go out in time and see what happens. Now this position is a real trade in that if volatility increases 1%, now we're talking about both option contracts, right? It would go across, this number would move. If it just moved 1%, this position long-term would have a $28 exposure. If it moves up 1 point, you would make $28. If it moved down 1 point, you would lose $28.
Thank you for listening to our podcast. To find more podcasts on options, stocks, alternative markets, and market data, please visit www.ise.com/podcasts.